In this video, I'm going to show you how much I made in 2023 investing in a money market fund with Vanguard. At the time of this recording, this money market fund has a yield of 5.28%, which is, I think, the highest out of any brokerage account. If we get right into the numbers, you can see that throughout the months, my dividends kept increasing and increasing. That's because as the Fed was increasing interest rates in 2023, this money market fund was increasing its yield. So I think at the beginning of 2023, it was about 4.7%. It ended the year about 5.33%. And in total, I got around $14,000 in dividends. Now, this is considered to be a settlement fund in Vanguard, which means the way to get it is you open up a Vanguard account, and any money that you put into Vanguard, it will automatically be put into the settlement fund. So all of the uninvested money you have in Vanguard will go into this fund. And the goal of a settlement fund is to keep the value of it at $1. So if you put $1 in, you can easily take $1 out. If you put in $1,000, you can use that $1,000 to invest in stocks and bonds, etc. You can even use it as collateral to trade options on, which I also did. And if it's just sitting there and not invested, it's going to earn this yield. And that is how I got my yield for the year. So if we look at some average numbers, I don't remember exactly how much I began the year with, but I had a pretty large cash position, about $280,000. The main reason I had all this cash was because I was thinking 2023 would be a recession. Everybody was calling for it. In the end, it did not happen, but that's one of the main reasons why I had a large cash position. And if we do an average of the 4.7 and the 5.3, the average APY I got was about 5%, which equates to the $14,000. So a few weeks ago, I also did a video on how I made $20,000 selling cash secured puts. I'm going to put a link to that video in the cards above. What this meant was that the cash in my brokerage account was kind of doing double duty. It was earning the yield, which was the $14,000. At the same time, I was selling these cash secured puts, and I earned an additional $20,000. The $14,000 I would be considering passive income because I literally didn't have to do anything. The $20,000 I had to actually go in and place option orders, so I was considered semi-passive. But if you added the two together, it's $34,000, which is about a 12.14% return only on my cash position that was sitting in my brokerage account, which is pretty good. So if you don't have an account with Vanguard, all the other brokerages like the Fidelities and the Schwabs, they have their own version of this. For Fidelity, I also have a Fidelity account, but I didn't have a lot of cash in it. The Fidelity version is called SPAXX, and the reason I had most of my money in Vanguard is because Vanguard's yield was the highest. As you can see here, Fidelity's 7-day yield is only 4.98%. I believe Schwab has one and theirs is about 5%. The Vanguard version is still the winner here. And these all work in a similar way. So if you have a Fidelity account and you deposit money into Fidelity, it's going to be put into the settlement fund and it's going to sit into this money market fund and you'll earn this yield automatically. It's important to note that this is different from a high yield savings account because this is not FDIC insured. Technically, this is a mutual fund. If for some reason that 1-to-1 dollar peg ratio does not keep, this fund could go to like 95 cents or whatever, and then basically catastrophe would have happened. Now, to be fair, if I'm comparing to the gains I would have gotten if I had invested in the stock market, the S&P returned 26% in 2023, and the NASDAQ or the QQQ returned 54 or 55%. So if I had just lumped all of my money into QQQ at the beginning of 2023, I would have been out a lot better. But again, I didn't do that. I was afraid of a recession, so I had a large cash position. I was dollar cost averaging into the S&P 500 at a slower rate. And of course, hindsight is 2020. Had I known the S&P would have gotten 26%, I would have just dumped all my money into the S&P. So at the end of the year, I missed out on a much bigger gain. Now, another thing to note is that 2024, the Fed is expected to be cutting interest rates. So as the rates are going to be cut in 2024, that 5.3% is going to become a little bit lower. Now, nobody knows how many cuts the Fed is going to do or when it's going to happen or any of that. And nobody really knows what's going to happen to the stock market when the Fed starts cutting these rates. But it is important to know that as the Fed cuts rates, the interest that you get in these money market funds will go down and the interest that you get in your high yield savings account will also start going down. So speaking of high yield savings accounts, I do have an account with Wealthfront as well. Their APY is 5% as of this recording. I think at the beginning of 2023, there was like in their low 4s. So I still chose to put most of my money in Vanguard. But this is a high yield savings account, which means it is FDIC insured, and they insure up to $8 million. Another thing I like about Wealthfront is because they allow like instant transfers and same day withdrawals. So when you go to take your money out or put your money in, it's a lot faster than a money market fund. It takes about like 3 days for you to get your money out, which is not that bad for a money market account. But with something like a Wealthfront, it's same day withdrawal. At the same time, if you have your money in a savings account, you can't take advantage of the stock market. So if stocks were to drop this year for whatever reason, you don't have that capital ready to deploy into the stock market, which is why I prefer my money in a money market fund. Now, there are some brokerages such as Robinhood. They offer a pretty high interest, so they offer 5%. The money in Robinhood is actually in a FDIC insured bank, or it's in this case it's at many different banks. So you kind of get the best of both worlds. Although the interest rate is a little bit lower at 5%, you can have your uninvested money be protected with FDIC insurance and also at the same time be in a position to deploy it if the market does come down. It could be a safer alternative to a money market fund, although money market funds are generally very, very safe. For Robinhood though, you do have to pay like a $5 monthly fee for this, and they call it a sweep. So a sweep account is similar to a settlement fund in which they sweep your money into these partner banks, and as you buy stocks with it, or if you want to withdraw, they have to sweep your money out, and then you can buy the stock or withdraw that money. It's also important to note that Robinhood does have a 1% bonus, which ends in January 31st of 2024. So if you transfer money into Robinhood from a different brokerage account, you're gonna get a 1% bonus on top of that. But you have to keep your money in Robinhood for 2 years, otherwise your bonus will go away. That's like the one caveat. But I'm going to experiment with it and I'm going to test it out. Personally, I like the money market funds because it allows me to sell those cash secured puts, and at the same time, I'll be making those high interest rate returns. If you found this video useful, please like and subscribe.